So when calculating depreciation, one can use different methods in order to do that. Number one, you could use the straight line method, or you could go for the diminishing balance method, which is also known as the reducing balance method, and sometimes also called the double declining rate method. So let's have a look at the differences in the formulae for the two. Number one, in the straight line method, we're going to use the cost. We're going to subtract the residual value, and that then is going to give me the amount that I can depreciate over the useful life. And then I'm going to take that amount and I'm simply going to divide it by the useful life of the asset. Right, alternatively, what I could do if I'm not given a useful life but I'm given a rate, for example, a useful life of 5 years would be the same as a depreciation rate of 20% on the straight line method. So in that case, I can again take my depreciable amount, which is the cost minus the residual value, and I'll simply multiply that by the rate that I have been given. Good, so useful life, or I'm just going to put in brackets here, of 5 years is going to equate to a rate of 20% on the straight line method. On the diminishing balance method, however, I'm not going to use the cost, but I'm going to use the carrying amount, and I'm going to multiply the carrying amount by the rate that I have been given, which will oftentimes, if I've got a useful life of 5 years, a rate of 20%, this rate here would probably be 40% in order to account for the larger depreciation at the beginning of the asset's useful life. Now, just a quick recap, the carrying amount is my cost minus the accumulated depreciation at the beginning of the year. At the beginning, so you're going to take the carrying amount also at the beginning of the year. Good, so that is just the different calculations that you're going to do for the different methods. And then lastly, also remember, if the depreciation is only for a part of a year, you're going to have to take your answer. So depreciation for a part of a year, you're going to take your answer that you get from either of the two methods, and you're going to say the answer, multiply that by the number of months, we call that n, over 12, and this n then represents the number of months that the asset was in use during the year. Number of months that the asset was used during the year. Good. Right. So when would you use the straight line method and when would you use the diminishing balance method? Now, as you will see from some of the examples that we'll do later, the straight line method is going to give you the same depreciation rate every year. The diminishing balance method, okay, so let's just write that down. The straight line method is going to give you the same depreciation each year. Same depreciation each year. The diminishing balance method is going to give you a larger depreciation during the earlier years of the asset's useful life. So larger depreciation during earlier years of usage. Good, and you will see how this works when we do an example. But as an entity, you would want to choose the method that best reflects the actual usage of the assets. And that is why the diminishing balance method was introduced, because there is a school of thought that believes that most assets are being worked or used more in the earlier years of the usage, rather than an equal usage each year, which you will arrive to when you use the straight line method. Nevertheless, that's just a quick summary of the two methods, and we'll do some more examples as we continue. Just something I would like to make mention of: if you're given a residual value under the reducing balance method, you will see we have not incorporated that in our formula here. The reason for that is that it is a manual check that one has to perform at the end of each year to make sure that the carrying amount is greater or equal to the residual value. What I mean by that is, at the end of each year, you're going to have to check that the depreciation that you calculated didn't cause your carrying amount to go below the residual value, because you cannot reduce the carrying amount to an amount that is lower than the residual value. So that's a manual check that you're going to have to perform to limit your depreciation if necessary. Happiness. Excellent.